They told you oil prices are easing. They told you the rally is exhausted after a 7% run. Look at the chart right now at 105.90. This is a textbook liquidity grab, and a violent price expansion is coming fast. There's one danger zone where bullish traders get slaughtered, and one hidden opportunity that will catch retail traders completely offside. I'm going to show you both exactly. Write these levels down immediately: 105.19 and 109.41. The price action that forms between these two numbers is the only thing that matters for crude oil right now. The session bias is clear, trending breakout continuation, and we are only in a short digestion phase. The immediate truth is simple: we are fading price to accumulate longs, not to reverse the trend. The critical invalidation level for the entire bullish structure is 102.60 on a daily closing basis. Mark this number down: 102.60. If we close below that level, the entire geopolitical fear premium evaporates, and oil drifts back into demand destruction territory. Until then, every tick lower is just a secondary entry for the next leg higher. The moving averages aren't just sloping up, they're accelerating higher. Let's start on the weekly time frame, because this is where the real roadmap lies. On the weekly chart, the 200-period moving average has finally flattened after months of tight compression, and price is breaking cleanly above it. This is a full structural regime change for crude. Weekly MACD is printing a bullish momentum bar, stronger than any we've seen in the last 8 weeks. Buyers aren't just present, they're in full control of the market auction. Drop down to the daily chart. The 60-day moving average is bending sharply higher, crossing above the 20-day MA, a classic momentum swing signal. But here's what most traders completely miss: price is stretched roughly 4% above the 20-day moving average. This is a high volatility, high-octane environment. It means you'll pay a premium to enter, and sharp volatility will shake weak hands out fast. Daily MACD is extended, but there is zero negative divergence yet. That's an extremely strong bullish signal. True exhaustion would look like price making a higher high while MACD makes a lower high, and we're not seeing that at all. This rally has real underlying fuel. Now the 4-hour chart is where the bear trap is being carefully set. We have a perfect bull flag pattern forming, with tight consolidation holding just above the critical 105.19 support level. The 4H20 period moving average sits at 105.50, acting as dynamic live support. The 60-period MA trails lower at 103.50, while the 200-period MA is far below, irrelevant for this immediate tactical battle. Look closely at the 4H MACD. It's curling down, crossing lower, with negative histogram bars printing. This is a hidden bullish signal. Price is consolidating sideways while momentum resets. This is a reload, not a reversal. If MACD resets near the zero line and price holds 105.19, the next push higher will be aggressive and fast. Key resistance above isn't just a single line, it's a structural supply zone. 109.41 is the immediate hard barrier, the high from the last geopolitical supply shock spike. Above that, 111.04 is a major liquidity pool, where massive stop-loss orders are stacked. The floor is locked at 105.19. A 60-minute close below that level exposes a quick flush down to 102.60. If you're a bullish buyer, you buy dips toward 105.50 and defend the 105.19 floor. If you're a seller, you only trade a confirmed breakdown, not this meaningless consolidation range. The overall structure is firmly biased to the long side. Headline news will tell you prices are easing after the 7% spike, but that's a retail-only narrative designed to make you exit longs too early. Here's the real reality. This pullback is a textbook relaxation of the geopolitical risk premium, simply taking a breather, not disappearing. Supply shock fears haven't vanished. They're just invisible to casual weekend headline readers right now. Inventories remain historically tight, and backwardation across the futures curve is screaming physical crude shortage. We have to cross-link oil to the broader macro landscape, because crude is the true geopolitical heartbeat of markets. Pull up the gold chart right now. Gold is not crashing, it's holding elevated levels. If this were a genuine risk-off deflationary dump across commodities, gold would be collapsing lower alongside spiking real yields. It's not. Gold is holding a strong bid, confirming institutional macro traders are hedging tail risks, not pricing in global pace. That underlying fear bid puts a solid floor under oil volatility. Now check the US dollar index and S&P 500. The dollar is consolidating, not ripping higher. A surging dollar historically crushes oil rallies instantly. If DXY was breaking out to multi-year highs right now, I'd tell you to short crude immediately. Instead, the dollar is muted. S&P 500 futures are holding steady. Equities are not pricing in a harsh recession that would crush energy demand. They're pricing a resilient global economy. This gives the oil breakout full macro permission to run higher. 1 week directional bias, grinding straight toward 109.41. 2 week bias, testing the 111.04 liquidity zone. The only major invalidation trigger is a geopolitical ceasefire combined with DXY spiking above 106. If you see that combo, the oil floor drops out completely. Until then, the path of least resistance is clearly up. We are in a strict buy-the-dip regime within a structural supply deficit story. Most viewers will skip this section, and that's exactly why most retail traders lose money. Keep watching closely, because this is where we turn market noise into a concrete, actionable trading plan. I'm breaking down 3 clear Brent crude strategies today: conservative, active, and aggressive. No ambiguity, just exact price levels and rules. Strategy 1, the sniper, conservative breakout play. This is for patient traders who only want high probability breakout confirmation. Do not buy the 105.90 range chop right now. Wait for confirmation. Trigger, a decisive 4-hour candle close above 109.41. That confirms the bull flag has broken, and old resistance flips to new support. Enter long on a clean retest of 109.41, not before. If it rips higher without retesting, you simply miss the trade. Discipline keeps your account intact. Stop loss placed at 107.90, just below the breakout candle midpoint. Target 1, 111.04. Target 2, 114.00, the next major volume gap level. Once target 1 hits, move your stop to break-even entry. This setup is completely voided if price breaks below 105.19 before hitting the 109.41 trigger. Strategy 2, the active trader, dip buy bull flag play. 4 smart contrarian dip buyers trading the current consolidation range. Act now on a pullback to the 105.50 zone, right at the 4H20 period moving average. Wait for a wick rejection or 60-minute hammer candle bouncing off 105.30 to 105.50. Then enter long. Strict stop loss at 104.70, safely below the 105.19 support low. First target, 109.00, right below major resistance. Take 70% of your position off at this level. Second target, 110.80. Just ahead of the 111.04 liquidity pool. Once target 1 is hit, trail your remaining stop up to 107.00 to lock in guaranteed profit, and let the market run with the rest of the position. This is how professional traders trade a bull flag resumption. Drop your Brent crude expected. Range for tomorrow in the comments now. Is it 105.50 to 108.00, or are you pricing an immediate breakout? I'm reading every single one. Strategy 3, the aggressor, intraday momentum scalp, high risk only, for traders who manage small losses and can handle heat. Bet on a momentum explosion from the 60-minute MACD reset. Enter on a break of the 60-minute micro-resistance at 106.40 on strong volume, chasing the mini intraday channel breakout, extremely tight stop loss at 105.80, just below the local swing low. First target, 107.80. Second target, 108.50. This trade needs immediate momentum. If it doesn't rip higher within 3 60-minute candles, exit manually for a scratch trade. If the 60-minute MACD histogram fails to flip positive on the volume spike, You're walking straight into a trap. Exit instantly. This is a scalper setup masked as a trend trade, hunting a gamma squeeze in the paper oil market. Hesitation here gets you burned fast. Let's recap the binary setup simply. The single most critical level for the next session is 105.19. Hold above it, and we load up for a breakout toward 109.41. Break cleanly below it, we step aside, stop out longs, and reassess at 102.60. That's your clear binary outcome. Tomorrow we are watching the API inventory whisper numbers closely. A drawdown over 3 million barrels reignites the bullish fuse immediately. A build cools the geopolitical premium temporarily. I'll be right here to map every move live if you want the full breakdown on how. Bitcoin and the S&P 500 divergence is signaling a major risk asset fracture. That video is live right now. Click the end screen to watch. It connects perfectly to this crude oil macro trade. Smash the like button if this analysis gave you a clear, actionable trading plan. Subscribe and hit the notification bell for daily institutional level crude coverage. I'll see you in the next video. Always trade the plan, not the market noise.